Hello everyone, my name is Kong and this is my presentation for Financial 500. I'll be analyzing the Sony Music versus Napster's case from August 2025 using accounting principles. This case involves unpaid royalties, copyright violations, and how both companies' financial statements reflect those events. Let's begin with an overview of the case. In this case, Napster reportedly streamed Sony's music without authorization after its licensing contracts expired. Sony claims over 9 million in unpaid royalties and up to 37.5 million in damages. This provides an excellent opportunity to analyze how financial transactions are recorded under accrual accounting principles. Sony recognizes revenue at the time music is streamed, even if Napster hasn't paid yet. Under accrual accounting, the income is recorded when earned, creating a receivable on the balance sheet and increasing revenue on the income statement. So as you can see, the debit account receivable is 9.2 million, and the credit royalty revenue is 9.2 million. After Napster repeatedly missed payments, Sony had to assess whether it could realistically collect the 9.2 million US dollars. To reflect that risk, Sony records a bad debt expense, creating an allowance for doubtful accounts. This keeps financial statements accurate and consistent with the matching principles. So the debit account for bad debt expense is 9.2 millions, and the credit is allowance for doubtful accounts, 9.2 millions. Under accounting rules like IAS 37 and ASC 450, Sony cannot record a contingent gain until the outcome is almost certain. However, it can disclose the potential gain in notes to financial statements. If the court rules in Sony's favor, the company would then recognize settlement income. So, if Sony wins, the cash or settlement receivable would be 37.5 million, and legal under the credit accounts would be settlement income 37.5 million US dollars. From Napster's perspective, failure to record unpaid royalties and pending legal liabilities distorts their financial picture. They should have recorded both royalty and legal expenses as liabilities. Proper accruals ensure that balance sheet and income statement reflect the true financial position. Financial statement reflects both earned revenue and unpaid obligation. In conclusion, this case shows that accurate financial reporting protects both companies and investors. Sony follow accrual and matching principles correctly, while Napster's failure to recognize obligations led to legal and financial risk. The lesson for managers is clear. Transparency in accounting supports ethical, data-driven decisions and protects a firm's reputation.